Are your work benefits really enough to protect your family? In today's episode, I want you to be able to answer that question because we're going to unpack the truth about employer benefits, what they cover, and what they don't, and why relying solely on it might leave your family unprotected. Let's talk about group benefits. Whether you're a young parent, a newcomer, or building your career in Canada, I want you to feel more confident in making a decision whether you have enough protection for your family and yourself. So let's start with the great things about employer benefits because they are a crucial part of a compensation package. In Canada, this typically includes a mix of extended health and dental insurance, life insurance, accidental death and dismemberment, disability insurance, retirement savings, and sometimes health spending accounts. So let's talk about extended health and dental insurance. You use this for your prescription drugs, dental work, vision care, and paramedical services like physiotherapy or massage therapy that you need. There's also life insurance as well as accidental dismemberment. Most employers offer a basic group life insurance that typically equals your annual salary. Some provide twice your annual salary or even up to four times. You also have the option to top up. You just need to pay a little bit more to get considered for a higher coverage. Then there's also accidental and dismemberment, which only pays out in the event of an accident. One of the things that is not most often talked about is the disability insurance. You would usually see this in your payslip. It shows LTD or disability coverage, and usually you'd pay a portion of it as well. So, what is a disability insurance? This replaces a portion of your income if you're unable to work because of an illness or an accident. For example, your company could replace your income 50 to 70% of what you're normally getting in the event you're not able to work. And then there's also retirement savings plans, whether this could be in the form of a group RRSP or a pension plan. Generous employers even offer health spending accounts. These are great for covering medical expenses that your main health plan doesn't. Think of an HSA as an annual allowance that is a tax-free money from your employer. For example, if you've had a prescription glasses and your main health plan only covers $200, but you bought it for $390, if you have an allowance in the HSA, then the $190 will be covered by that health spending account. So think of it like anything that the CRA would also consider as an eligible medical expense. Employer provided coverage is really something great that we are offered. That's usually what I ask the people that I talk to on a day-to-day basis. I want to know what their coverages are so that I can help them understand what they already have and what they need to do to supplement that if needed. So having employer benefits is really good to have because you don't pay as much as compared to when you're paying for an individual insurance. And then it's typically guaranteed acceptance, or you would usually be eligible right away without evidence of insurability, depending on the basic amounts or depending on the limits that the company would offer. And it's also very convenient as well when it comes to payment because it's already taken out of your payroll. So you don't really feel the pinch of having to pay for something compared to having it by yourself. The reality check is there are common gaps if you're only relying on your employer benefits. And we're going to talk about that as well. Most employer plans provide a group life insurance that is equal or two times your annual salary. So let's say you earn 50,000, your coverage might just be 50,000 to 100,000. Experts usually recommend a death benefit that is up to 10 times your annual income. According to the Canadian Life and Health Insurance Association, the average household life insurance protection is around $483,000, which is still only about 5 times the average household income. So even with a group plan, most Canadians are underinsured. Now, think about what your family needs to handle if anything happens to you. The first thing that would come to mind is the final expense. The average funeral cost, at least here in Canada, costs around $9,000, and this is an immediate expense. Sadly, some people would have to put it on credit, which we don't like. There's also a final tax bill. For example, if you're someone who owns cottages or several properties, this could trigger a high tax amount because it is considered as if you're selling your property when you pass away, even if you don't. Think about your debts. So, if you have mortgage, car loans, or a line of credit, your debt benefit needs to be big enough to cover these debts so that they don't become a burden to your family. Future income needs to be considered as well. How many years of your income would your family need to replace if anything happens to you? Is your family gonna be okay without your income? Realistically, how long do you think they would need your income for to be able to maintain the same lifestyle? How old is your youngest child? Don't forget about the education cost as well. Education for our kids is something that we always think about, and that's why we save for that as well. And there's the portability problem as well. That is the most significant and often overlooked. Your employer coverage is tied to your job. And that means that when you change jobs, you get laid off or take a leave of absence, then that coverage that you have can just disappear. What if your health has changed since you started that job? Getting a new affordable coverage might be impossible at that point, and this could create a critical period of vulnerability on your end. Now, I want to talk about long term disability and critical illness. Often, employers provide long term disability, but many people mistake it for something else. You'll commonly see LTD on your payslip and you're paying for it. Long term disability insurance is a fantastic benefit that not a lot of people talk about. It depends on your employer what the percentage is for the coverage. It typically runs from 50 to 75% of your salary, and this is replacing your income only in the event that you're unable to work due to an illness or injury. The benefit is paid out in monthly installments and continues as long as you're unable to work. The key here is the inability to work. Now, comparing it to critical illness, which is very different, critical illness insurance pays you a single tax free lump sum payment if you are diagnosed with one of the specific illnesses listed in the policy. For example, cancer, heart attack, stroke, and to be eligible, you have to survive a set waiting period. Why is this a critical gap? With a critical illness diagnosis, it doesn't always mean that you can't work. For example, you might be able to work from home even if you're critically ill, or you might be only off for a few months. In these cases, your long term disability might not kick in or would only pay for a limited time. However, the lump sum from a critical illness policy, on the other hand, can be used for anything. You can use it to pay down your mortgage, cover expensive private treatments not covered by your group health plan, or even home modifications to aid your recovery. It is a living benefit that gives you financial freedom to focus solely on getting better. Now, how do you know if your coverage is enough? Let's walk through a simple framework to help you assess your needs. Step one is to add up your immediate cost, the balance on your mortgage or any other outstanding debts, the average cost of a funeral, an estimate of your final taxes and estate fees. Step two would be to calculate your ongoing support needs. How many years of income would your family need to replace? Think about if you need to fund your children's education, which usually is the case. Step three would be to subtract your existing assets. So look at if you already have existing savings, investment, or any other life insurance policies that you already have. The difference between your total needs and your existing coverage is your shortfall. And you'll likely discover that your group benefits don't come close to covering that gap. How can you take action? Your employer coverage is really a great foundation, but it's rarely sufficient on its own. The smart strategy is to use a layered approach, which means keeping your employer coverage while adding a personal policy to fill the gaps. Now, this is where a personal life insurance policy, such as a term life insurance, comes in, and it's affordable and provides a higher death benefit for a specific period of time, which makes it perfect to cover your mortgage and your kids' younger years for you. Term life insurance is portable and it stays with you no matter where your career takes you. And you can even go with a permanent life insurance, maybe a smaller amount compared to your term life insurance to make sure that you have something in place for final expenses and final taxes. Now, if you want to feel confident and protected, I highly recommend that you see a life insurance advisor or maybe a financial planner. My job as a life insurance advisor is to help you understand if your current coverage is enough or if there are any gaps that could leave your family unprotected. Let's have a conversation. You can book a free, no obligation chat with me to review your situation. I'll listen to your needs and help you discover if your current coverage is aligned with your goals. So, to book a chat, go to marianagudo.com. I truly believe that whether you're a young parent, a newcomer, or just building your career, it's important to have this kind of conversation to make sure that you're confident about protecting yourself and your family's financial future. Thanks for listening to the Unpacked and Empowered podcast. Again, this is Marianne. Stay safe and be well protected. If this episode resonated with you and you found value in what we discussed today, kindly hit the like button, subscribe, and share this to your friends so other people would see what we're sharing here on the podcast as well. This podcast is for informational purposes only and should not be considered personalized financial advice. I'm a licensed insurance advisor in New Brunswick and Ontario, so please consult with a licensed professional for recommendations based on your specific situation. Thank you, and you have a great day.